wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 191, and in this episode we are reviewing the performance of the financial markets during the 51st week of 2025, and that is from Monday the 15th to Friday the 19th of December. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Tuesday, the Bureau of Labor Statistics released the much-awaited employment report for November, which was delayed by the U.S. government shutdown. According to the report, nonfarm payrolls grew slightly more than expected in November, whilst unemployment hit its highest level in over 4 years. The growth in jobs was recorded at a seasonally adjusted 64,000 jobs for the month of November, which was better than the Dow Jones estimate of 45,000 jobs, and was in total contrast to a sharp decline in October. The unemployment rate, however, rose more than expected to 4.6%, which was the highest rate since September 2021. Staying stateside, consumer prices rose less than expected in the month of November, giving investors hope that inflation may be cooling off enough for the Federal Reserve to continue easing monetary policy. A delayed report from the Bureau of Labor Statistics showed that the Consumer Price Index rose at an annualized rate of 2.7% in November, which was lower than the consensus forecast of 3.1%. Meanwhile, the Core Consumer Price Index, which strips out volatile food and energy prices, this also came out cooler than expected at 2.6% compared to the forecast rate of 3%. Following the release of the inflation data, according to the CME's Fed Watch tool, traders now pricing in about a 58% probability for a rate cut in March 2026. Over to the United Kingdom, where according to the latest figures from the Office for National Statistics, the rate of inflation in the UK cooled sharply to 3.2% in the month of November, boosting the probability that the Bank of England would cut interest rates on Thursday during its final policy meeting for this year. Economists polled by Reuters had expected inflation to come out at 3.5% in November, down from 3.6% in October. Meanwhile, core inflation, which excludes volatile food and energy prices, also rose by 3.2% in November, down from 3.4% in October. And according to the chief economist, lower food prices were the main driver for the decline in inflation. Staying in the United Kingdom, following the cooler-than-expected inflation report, the Bank of England voted by a narrow margin to cut interest rates on Thursday, which was its last monetary policy meeting of 2025. The central bank's 9-member Monetary Policy Committee voted 5-4 in favor of a 25 basis point rate cut, bringing its benchmark rate down to 3.75% and marking its fourth rate cut of the year. Economists had widely expected the Bank of England to cut its policy rate on the back of weak economic data, a softening labour market, and the recent decline in inflation. In its official statement, the Monetary Policy Committee said that whilst inflation remains above the central bank's 2% target rate, it cautioned that the extent of further easing in monetary policy will depend on how the outlook for inflation will evolve. Moving over to the Eurozone, on Thursday, the European Central Bank decided to keep its policy rate on hold as it revised upwards some of its growth and inflation projections, which reduces the probability of further rate cuts in the near term. Recent growth figures for the Eurozone have beaten market expectations, lifted by domestic spending that has counterbalanced a slowdown in manufacturing. Meanwhile, inflation has continued to hover around the central bank's 2% target rate and is expected to remain at this level for the foreseeable future. According to Reuters, policymakers are indicating that they expect to keep interest rates on hold in 2026, but are not prepared to rule out a move in either direction because of increased uncertainty in the global markets. To the land of the rising sun, where on Friday the Bank of Japan raised its short-term policy rate to the highest level in the past 30 years, driving a sell-off in government bonds, whilst signaling its commitment to tighten even further as it pushes ahead with policy normalization. The Bank of Japan raised its benchmark policy rate by 25 basis points to 0.75%, which was in line with market expectations and is the highest policy rate since 1995. Following the decision, the yield on the 10-year Japanese government bond rose about 5 basis points to 2.019%. Japan embarked on policy normalization in 2024, shifting away from a negative interest rate regime that had been in place since 2016. The latest inflation data shows that consumer prices in Japan increased by 2.9% in November as inflation continues to run above the Bank of Japan's 2% target rate for the 44th consecutive month. On Wall Street this past week, U.S. stocks rose on Friday, lifted mainly by a turnaround in Oracle as the artificial intelligence trade regained its footing after experiencing some volatility. Oracle shares were up by 6.6% after TikTok agreed to sell its U.S. operations to a new joint venture that includes Oracle and a private equity investor by the name of Silver Lake. Oracle shares had come under pressure earlier in the week after a report revealed concerns about the company's debt and the high level of spending on artificial intelligence. All the three major indices recorded gains on Friday, with the tech-heavy Nasdaq Composite rising by 1.3% to close the week at 23,307, whilst the broad market index, that is S&P 500, inched up by 0.88% to end the session at 6,834. And last but not least, the 30-stock Dow Jones Industrial Average advanced by 183 points on Friday before settling at 48,134. In the government bond market, U.S. Treasury yields ticked higher on Friday as investors digested the latest inflation data, which came out cooler than expected. The downward trend in inflation gave investors some hope that the Federal Reserve will continue cutting interest rates in 2026. The odds for a January rate cut remain pretty low, but according to the CME's Fed Watch tool, traders are now pricing in about a 58% chance for a rate cut in March. The yield on the short-dated 2-year Treasury note was up by more than 2 basis points at 3.48%, whilst the yield on the benchmark 10-year Treasury bond rose by more than 3 basis points to settle at 4.15%. And just for your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil rose on Friday after President Trump said that he would not rule out the possibility of war with Venezuela. President Trump has been ramping up pressure on President Maduro and recently ordered a blockade of oil tankers off the Venezuelan coast after seizing an oil tanker the previous week. For your information, Venezuela is a founding member of OPEC and has the largest proven oil reserves in the world. And according to data from Kepler, Venezuela exports about 749,000 barrels per day, with about half that volume going to China and about 132 barrels going to the United States. Despite the foregoing, the oil market is not projecting a major disruption to oil supply, mainly due to the possibility of a peace agreement between Russia and Ukraine. In response, the price of U.S. crude rose by 0.9% to close at $56.66 per barrel, whilst the price of the global benchmark Brent crude gained by more than 1% to settle at $60.47 per barrel. In the precious metals market, silver continued to steal the spotlight from gold as it soared to a record high on Friday, bolstered by investment demand and supply constraints. Meanwhile, gold was on track for a weekly gain, supported by expectations that the Federal Reserve will continue cutting interest rates in 2026. The price of spot silver has risen by 132% so far this year and saw a weekly gain of about 8% as it came to a close at $66.96 per ounce. Meanwhile, the price of spot gold has increased by 65% so far this year and was on track for a weekly gain of more than 1% before closing the week at $4,346 per ounce. We now change scene to the Kenyan financial markets. And as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling appreciated marginally versus the US dollar And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 128.94 compared to 129.16 the previous week. Meanwhile, the sterling pound was priced at 172.18 and the euro was valued at 151.24. And on the regional front, one Kenya shilling was changing hands for 27.65 Ugandan shillings and 19.12 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.29. The International Monetary Fund has raised concerns about the stability of the Kenya shilling, but the central bank confirms that it continues to adopt a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been staggered between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $68 million for a grand total of $12.13 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances to Kenya totaled to $388 million in November 2025, down from $423 million in November 2024, which was a decline of 8.3%. Meanwhile, the cumulative inflows for the 12 months to November 2025, this increased to $5.04 billion compared to $4.87 billion for a similar period in 2024, which was an increase of 3.6%. The inflow of remittances remains a major source of foreign exchange earnings and continues to support the balance of payments as well as the domestic foreign exchange market. In the money markets, during the past week, the interbank market was liquid and remained well funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate declined from 9.05% the previous week down to 8.98%, which remains in line with the new central bank rate at 9%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 23.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 18th of December, and the central bank received bids totaling to 16.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 67%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate remained stuck at 7.77%, whilst the 182-day rate continued to maintain at 7.80%, and the 364-day rate declined by less than 1 basis point to average out at 9.22%. In the secondary bond market, the Central Bank of Kenya is offering bond investors an opportunity to switch their investment from a bond that is due to mature in August 2026 and to reinvest their funds in another bond which matures in April 2037. The offer to switch has been made to holders of bond issue number FXD1/2016/010. This bond has a coupon rate of 15.03% and a yield to maturity of 8.02% and matures in August 2026. Holders of this bond are being offered an opportunity to reinvest in bond issue number FXD1/2022/015. This bond has a coupon rate of 13.94% and has 11.3 years left to maturity, that is until April 2037. Please note that participation in this switch auction is on a voluntary basis, and investors who choose to participate may opt to switch either part or the full amount of their bond investment. At the Nairobi Securities Exchange, Diageo PLC has agreed to sell its 65% stake in East African breweries to Japan's Asahi Holdings. This deal is valued at $2.35 billion, which is equivalent to 303 billion shillings. This transaction involves the sale of Diageo's 100% holding in Diageo Kenya Limited, which holds a 65% stake in East African breweries. However, even before the ink has dried, the Capital Markets Authority has questioned East African breweries to explain the timing between the bond issuance that raised 16.8 billion shillings and the announcement of the sale by Diageo PLC, which all happened within a span of 35 days. East African Breweries closed its bond issue on the 12th of November, whilst its parent company, Diageo PLC, announced its planned sale just last week on Tuesday, the 16th of December. The sale announcement has sparked market speculation that East African Breweries had offered the bond for sale with prior knowledge that Diageo was planning to offload its shareholding in the company. This action has triggered regulatory oversight, given that East African Breweries is listed on the Nairobi Securities Exchange, and the exit of a majority shareholder is deemed as material information that ought to have been made available to bond holders. In response, In a notice published on Thursday, the 18th of December, East African Breweries said it was not aware of the planned exit by its parent firm Diageo plc when it issued the 5-year bond for sale to the public. Up next is our topical issue, and this week we're looking at the Treasury's compliance with the public debt limit. Despite a 5-year implementation window, Kenya's National Treasury is currently off track with regards to compliance with the public debt limit, highlighting the challenges of persistent budget deficits. The latest projections by the Treasury shows that the country's debt will remain above the anchor limit of 55% of the gross domestic product until 2030, which is 2 years after the set deadline. The Public Finance Management Act of 2023, which scrapped the fixed debt ceiling limit that was previously set at 10 trillion shillings and replaced it with a floating cap that is pegged to the country's economic performance and which was set at 55% of the country's gross domestic product. However, after years of excessive budget deficits, which translated into increased debt, the Parliament decided to provide the Treasury with a 5-year grace period to restore fiscal discipline and to comply with a new floating cap of 55% of GDP. In the annual debt management report for the period ended June 2025, the Treasury estimated that the present value of total public debt stood at 63.7% of GDP. This ratio is expected to decline gradually in the coming years on condition that the government implements strict spending controls and continues to grow revenue collections. But even then, the national debt is only projected to fall below the anchor limit for the first time in 2030, which is 2 years behind the set deadline. The law is, however, silent on the penalties to be imposed should the debt anchor limit remain in breach beyond the implementation period. The lack of automatic spending cuts, borrowing limits, or sanctions in the event of non-compliance means that enforcement of the public debt limit is largely dependent on the Treasury's fiscal discipline and parliamentary oversight. Despite repeated commitments to fiscal consolidation, debt accumulation has continued unabated, exposing a widening gap between policy intentions and implementation. Since 2020, Kenya has been classified by the International Monetary Fund and the World Bank as being at a high risk of debt distress. According to the latest data from the central bank, Kenya's national debt rose by 1.3 trillion shillings in the 12 months to November 2025 and totaled to 12.25 trillion shillings, and this was divided between domestic debt, which stood at 6.78 trillion shillings, and foreign external debt that is valued at $42.1 billion, which is equivalent to 5.46 trillion shillings. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhurij@gmail.com. Jamuhuri is spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead, and a Merry Christmas to you all. But before we go, please remember that solitude is the gateway to self-actualization and creativity. Think about it. Thank you, and God bless.